Welcome back to our corporates. Now we are discussing the key differences between one-person company and sole proprietorship. Should I start my business as a sole proprietorship or should I register an one-person company? So in this video, I will explain what is sole proprietorship, what is one-person company under Companies Act 2013, and the key legal provisions and the differences, taxation and compliance differences, court rulings and landmark judgments, global perspective on single member companies, which form is better for entrepreneurs and startups. First, we will understand the sole proprietorship. Sole proprietorship is the oldest and simplest form of the business. It is not separate legal entity, which means the owner of the business are one and the same in the eye of the law. What are the features of sole proprietorship? Formation. No specific registration under the Companies Act is required. However, state laws such as Shops and Establishment Act, GST, or professional tax registrations may apply. And legal status, no separate juristic personality. So business is equal to owner, that's all. Liability, unlimited liability. Personal assets of the proprietor can be attached for the business debts. Continuity, life of the business ends with the life of the proprietor. So there is no perpetual succession. Taxation, taxed as an individual income. Eligible for presumptive taxation under section 44 AD, 44 ADA, 44 AE of the Income Tax Act 1961. These are the features. Even if you see the judicial precedent in Ashok Transport Agency versus Avdesh Kumar and another in 1998, the Delhi High Court held that a sole proprietorship has no separate legal entity. Any suit filed in the name of the proprietorship is deemed to be filed by the proprietor personally. So this means the law does not recognize a proprietorship as a separate person, unlike companies or LLPs. Now we'll understand one-person company. It is a modern concept introduced by Companies Act 2013 under Section 2, subsection 62. What Section 2, subsection 62 says? This is what Companies Act. Go to MCA, Ministry of Corporate Affairs. Here you can come to Chapter 1 preliminary and here definition 2, then Section 2, subsection 62. If you come down to 62, then I'll show you the definition. 43, 46, 54, 60, 62. This one. Definition, one-person company. One-person company means a company which has only one person as a member. This is what the definition given in section 2, subsection 62 of Companies Act 2013. Then we'll move on to our thing. Then understanding this one-person company, it is a modern concept introduced by Companies Act 2013. It allows a single person to incorporate a private limited company while enjoying corporate benefits. And we will discuss the features. Separate legal entity, one person. OPC, one-person company, is distinct from its owner. It has a limited liability. The member's liability is restricted to the unpaid value of the shares. Personal assets are protected. Formation, yes, it requires digital signature, it requires director identification number, DIN number, and filing of SPICE plus form with MCA. So must include suffix OPC Private Limited. So by seeing the name itself, we can find, yes, this is one-person company. Nominee, a nominee must be appointed to take over in case of death or incapacity of the sole member. Compliance, yes, must file annual returns, board resolutions, maintain statutory records. Taxation, one-person company is taxed as the company under Income Tax Act. Then in Budget 2021 update is, earlier OPC had restrictions on paid up share capital and turnover. So these were removed in 2021, allowing OPC to grow without such limits. Will comparison through case laws. Bombay High Court in the matter of innovative Film Academy one-person company versus Endemol India Private Limited 2025, very recent case. The issue was whether the liabilities of one person, OPC, liabilities of one person company can be extended. Liabilities can be extended to its sole director personally. Court held, signing by the director on behalf of the OPC does not make him personally liable. The doctrine of separate legal personality applies. Strong protection of limited liability for one-person companies. And in another case, Ashok Transport Agency versus Avadesh Kumar 1998 court clarified that sole proprietorship has no separate identity. All liabilities are personal liabilities of the owner. These two judgments together highlight the fundamental differences between the one-person company and sole proprietorship. So the proprietorship is equal to unlimited liability, no legal separation. OPC is equal to limited liability, separate legal entity. And if you see internationally, Salmon versus Salomon and Company Limited 1897, you see the old judgment. The landmark UK case established that even one-man company is separate entity. This principle is mirrored in Indian one-person company law, OPC law. Taxation and compliance, yes, sole proprietorship taxation taxed at individual slab rate. Compliance burden is minimal, only ITR filings and relevant registrations. Whereas one-person company taxation taxed as a domestic company. No presumptive taxation. Higher compliance cost compared to sole proprietorship because ROC filings will be there, board meetings will be there, auditor appointment will be there, annual returns will be there. Mandatory statutory compliance. The advantages and disadvantages with the sole proprietorship, advantages are easy to start and close. Low cost, minimal compliance. Suitable for small traders, freelancers, professionals. The disadvantages with the sole proprietorship is unlimited liability, no perpetual succession, hard to raise funds or expand because of proprietor. Whereas in one-person company, the advantages are limited liability protection, separate legal entity, continuity through nominee system in one-person company, higher credibility with banks and investors compared to sole proprietor. Disadvantages are there, higher compliance cost, corporate taxation rules apply, limited to one shareholder only. We'll see the global perspective in UK recognized single member companies since Solomon case. USA LLCs and single member corporations widely accepted. Singapore allows single shareholder private companies. India introduced one-person company in 2013 Act to align with the global best practices and promote startups. So when to choose sole proprietorship? If you want simplicity, low compliances, and are running a small business or professional practice, then better go for sole proprietorship. If you want limited liability, separate entity, separate identity, and plan to scale or raise investment, then go choose one-person company. OPC may later be converted into private limited company when business expands. Now the conclusion is sole proprietorship and OPC may appear similar because both can run by a single owner, but legally and fundamentally these are two separate. Because the proprietorship is equal to simplicity but unlimited liability. OPC protection, credibility is there, but higher compliance because it has a limited liability. The Bombay High Court in 2025 reaffirmed that one-person companies enjoy the benefit of separate legal personality, which protects entrepreneurs. On the other hand, proprietorship still exposes owners' personal assets to risk. See, which is better? It depends on your scale of business, vision, and risk appetite. We have two channels, RR Corporates, other channel RR Legal Talks. Please do subscribe and hit the bell icon so that you will not miss any of our latest videos. Thank you.